Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today we're doing an intensive investigation into Caterpillar Inc. We're looking at a really interesting dual narrative they've presented.
A dual narrative, that's a good way to put it.
On one hand, you have their recent Q3 2025 financial results, and on the other, this really ambitious long-term strategic vision they just unveiled at their November Investor Day.
And this feels like a genuinely crucial moment for Caterpillar. I mean, we're scrutinizing a company that is, historically known for its cyclical nature.
Very cyclical.
But now it really seems like they're positioning themselves for a major structural shift, a shift driven by these massive secular tailwinds. We have a whole stack of sources here, everything from the detailed 10Q filing to the transcripts from that 2030 vision presentation.
And the initial tension is just, well, it's palpable. You can feel it in the numbers.
Absolutely. The headline performance figures for Q3 2025, they showed this really robust top-line momentum. Consolidated sales and revenues hit, $17.64 billion. $17.64 billion. And that's a very healthy 10% increase year over year.
But the truly compelling signal, I think, about future stability, it's not just that revenue number. It's the record backlog.
The backlog is the real story here.
And what a record it is. The backlog closed out the third quarter at an all-time high, $39.8 billion. That's a sequential increase of $2.4 billion in just 3 months. To me, that $39.8 billion number, it's the anchor for this whole strategic discussion.
It has to be.
It signals that, despite all the global economic noise and geopolitical tension, customers are placing these long-duration, high-commitment orders.
It absolutely does. It essentially de-risks the short to medium term. Management was very explicit about this. They framed this record backlog as positioning the company not just for immediate growth, but for sustained long-term profitable expansion.
Right. So our mission here is to really synthesize the data. Are the current short-term financial pressures, are they just noise? Maybe a transitional cost on the path to these elevated 2030 targets? Or, and this is the key question, do these pressures point to deeper structural issues that might undermine this aggressive new guidance? That's what we need to figure out.
Okay, so let's unpack those Q3 financials. We noted the impressive 10% jump in sales to $17.64 billion. That's mainly driven by higher sales volume, more equipment going to end users.
Right.
But that celebratory feeling, it just hits a wall immediately when you look at the profitability metrics.
The classic case of profit pull-through compression. Despite that strong revenue growth, the consolidated operating profit actually retreated. It went down by 3% year over year.
So from $3.7 billion in Q3 of 24.
Down to $3.02 billion in Q3 2025. And that 3% decline on a 10% revenue gain. That is the core puzzle of the quarter.
And that deceleration, it just hammered the margins, the adjusted operating profit margin, the AOPM, which is really the key metric we use to assess core profitability, right?
Exactly. It strips out the one-off item.
That was only 17.5% for Q3.
And we have to put that 17.5% in context for you. That's a significant drop compared to the 20.7% AOPM they delivered in the same quarter last year.
Over 300 basis points.
A huge drop.
Yeah.
And while 17.5% is still, a healthy number in isolation, dropping over 300 basis points year over year signals that cost inflation. And these external policies are eating up nearly all the leverage that should have come from that strong volume growth.
This profit pressure, it translated directly to the bottom line. GAAP profit per share was $4.91.
Down from $5.09 in Q3 of 2024.
And the adjusted figure, which again gives us a clearer picture of the operational reality, was $4.88 this quarter versus $5.06 last year. We really need to spend some serious time dissecting why that profit got hit so hard.
Absolutely. When we analyze the variance drivers for that operating profit decrease, that $95 million drop, 3 things stand out, and one of them just dominates.
Okay.
The biggest driver was unfavorable manufacturing costs, which totaled a staggering $686 million.
Wait, hold on. $686 million in unfavorable manufacturing costs in a single quarter. That's enormous. This isn't just inflation, is it? This has to go back to the tariff issue.
It does, unequivocally. Management attributed the bulk of that $686 million specifically to the impact of higher tariffs. For Q3 2025 alone, the net impact of those incremental tariffs was estimated to be near the top end of their projected range.
Which was what, 500 to 600 million?
Exactly. So this wasn't just a minor headwind. It was a Category 5 hurricane hitting their cost structure.
Okay, so if tariffs were running close to 600 million and the total unfavorable manufacturing cost was 686 million, that means tariffs accounted for nearly 90% of those cost pressures.
Pretty much.
Yeah.
The remainder of the operating profit decline came from two other smaller elements.
Which were?
The second contributor was unfavorable price realization. That chipped away another $191 million from profit.
Okay, so that suggests that in certain product lines, they couldn't pass on all the costs, probably in construction industries where it's so competitive.
That's the likely culprit. They had to sacrifice some pricing to maintain that volume.
And the third factor was higher expenses in SG&A and R&D.
Exactly. Selling, general and administrative, and research and development expenses were higher by about $129 million. Now, some might see this as just pure cost inflation, but management noted it was primarily driven by higher compensation, including short-term incentive pay.
So on one hand, that higher incentive pay suggests they're hitting some internal metrics, but on the other, it just adds to the margin pressure in a really tough environment.
Precisely. And looking at the 9-month period confirms this isn't just a Q3 blip. Total sales for the 9 months were $48.456 billion, slightly down from last year.
And more critically, the 9-month AOPM fell from 21.5% last year to 17.8%.
That sustained drop from that 20+% range down to the high teens. It confirms the systemic impact of these tariff and cost headwinds across the entire year. It makes the 2030 margin targets, which we'll get to later, look even more aggressive.
It really does. It requires some massive structural improvements to overcome this level of cost friction.
For sure.
But despite this intense profit pressure, let's talk liquidity and cash generation. Caterpillar has historically been, a cash machine. Did that hold true?
Absolutely. The machine and engine segment, or ME&T, remains an incredibly powerful cash generator. They produced $3.2 billion in free cash flow during Q3 alone.
Just in the third quarter.
Just in Q3. And for the 9-month period, ME&T free cash flow stood at $5.801 billion. Now, that is down a bit from the $6.4 billion in the first 9 months of 2024, which reflects the lower operating profit.
Of course.
But the ability to generate multi-billion-dollar free cash flow quarterly is the bedrock of their financial stability.
So if they're generating $3.2 billion in free cash flow, how much of that are they actually deploying to shareholders?
They remain highly committed to capital return. In Q3, they deployed about $1.1 billion to shareholders through dividends and share repurchases.
And for the full 9 months?
For the 9-month period, they repurchased 11 million shares for a total cost of $4 billion, alongside those very consistent dividend payouts.
The dichotomy here is just striking, isn't it? You have this record backlog signaling massive future demand. You have $3.2 billion in cash generated in a single quarter. Yet margins are being heavily compressed by over $600 million in tariff costs.
It's the defining feature of this report. Strong underlying momentum, foundational financial strength, but profitability is being taxed, literally due to external trade policy volatility and all the manufacturing costs that come with it. The company is performing well, but the environment is severely challenging that margin structure.
Okay, let's move to the individual business segments because the results were, well, highly polarized across the 3 major divisions. We should start where the volume is highest. Construction industries or CI?
CI reported strong top-line metrics. Sales reached $6.76 billion, up a solid 7% year over year.
So that confirms infrastructure spending, residential and non-res construction. Those markets are still pretty healthy.
They are. However, the segment profit performance was the complete inverse of sales.
Right. The segment profit dropped 7% to $1.77 billion. Higher sales, but lower profit. That means the margin crunch was particularly acute in CI.
It was. And management gave a very specific figure on the tariff impact here. The net effect of incremental tariffs had a negative impact on CI's segment margin of approximately 340 basis points.
340, so that's more than 3 percentage points just wiped out by trade costs alone.
That's it. So if CI had managed to shed those tariffs, the margin would have actually been significantly higher than the previous year. It suggests the underlying operating performance and the volume leverage are actually excellent.
That's the exact conclusion they wanted us to draw, isn't it? They noted that excluding the tariff drag, the margin was slightly higher year over year.
It illustrates exceptional underlying execution in a really competitive market, but CI is the segment that's just most exposed to the current tariff regime. It's bearing the heaviest burden.
Okay, next up is Resource Industries RI, which covers mining and all the large equipment. Their sales were more subdued, up only 2% to 3.11 billion.
Correct. But the profit collapse was even more severe than in CI.
Worse than CI.
Oh yeah. Resource Industries segment profit decreased by a substantial 19% year over year. It settled at just $499 million.
Wow.
This pulled their segment margin down sharply to 16%. That's a decrease of 430 basis points from the prior year's margin.
What drove that dramatic 430 basis point erosion?
Again, tariffs were a primary villain. They impacted the RI margin by about 260 basis points.
So that's most of it, but not all of it.
Right. Unlike CI, RI also suffered significantly from unfavorable price realization, which just compounded the profit decrease. This suggests that while demand is strong, and we see that in the long-term mining CapEx forecast, the short-term pricing environment for large mining equipment was really difficult in Q3.
And there was an interesting inventory note in the RI segment as well, something about advanced shipment timing.
Yes, good point. Sales to end users were actually a little stronger than expected, but this was attributed to early shipment timing, which means sales were basically pulled forward from Q4 into Q3.
So that resulted in a decrease in dealer inventory in Q3, which looks good on paper for the quarter.
It does, but it sets up a potentially tougher comparison for the fourth quarter, which is a key point when we get to the near-term guidance.
Okay, now let's transition to the growth engine, energy and transportation, or E&T, which is now, of course, formally transitioning its branding to power and energy.
P&E, yes. And this segment clearly distinguished itself.
How so?
P&E was the undisputed driver of financial success in Q3. Sales soared 17% year over year to $8.397 billion. And crucially, unlike CI and RI, segment profit mirrored this high growth. It was also up 17% to $1.678 billion.
That perfect profit pull-through is remarkable. It means that P&E was able to maintain stable margins despite all the inflationary pressures hitting the other segments. What is P&E doing right that the others are struggling with?
It is pricing power. Simple as that. It's driven by secular demand that is just overwhelming the cost headwinds. Growth was fueled by higher sales volume and critically favorable price realization. They're in structurally strong markets.
Like power generation.
Exactly. Power gen sales have grown by more than 70% over the last 5 years. It's a phenomenal track record. And during Q3, oil and gas, industrial and transportation sales all increased robustly, about 20% year over year. The oil and gas strength was tied primarily to high demand for turbines and related services.
So the ability of E&T, or P&E, to realize that favorable pricing is the key differentiator here.
It's everything. And it's why that record backlog, which increased sequentially by $2.4 billion, was largely driven by robust ordering in power gen and oil and gas product lines. Customers are clearly prioritizing securing future capacity in this segment.
It just demonstrates that where demand is highest, especially for these long-duration, high-commitment assets like turbines for LNG or power generation, Caterpillar can maintain superior pricing and volume growth and offset the cost pressures that are crippling the machine segments.
That's the story of the quarter in a nutshell.
Okay, finally, let's briefly touch on financial products, FP. Revenues were up 4%, but profit was slightly down.
Right. FP segment profit was $241 million, down 2%. That was primarily due to a conservative $15 million higher provision for credit losses at Cat Financial.
But if you look past that small accounting adjustment, the health of the underlying credit portfolio is exceptionally strong, isn't it? It's a great proxy for customer financial health.
It's an excellent proxy. And management was very keen to highlight that past dues were just 1.47% at the end of Q3.
1.47%, that's incredibly low.
It's down 27 basis points year over year, and it is the lowest third quarter past due rate they've seen in over 25 years. The allowance rate for credit losses was just 0.89%, which is near historic lows.
That is a staggering sign of customer solvency and market stability. If their customers were worried about the economic outlook, you'd expect those metrics to be rising, not hitting generational lows.
Precisely. And what's more, retail credit applications increased 16%, and new business volume grew 7%. This just confirmed that customers feel confident enough in their own businesses to finance large equipment purchases, and Cat Financial is comfortable underwriting that risk at historically low loss rates.
It really provides a strong counterbalance to all the anxiety generated by those tariff headwinds.
It really does.
Okay, moving from the performance review to the outlook. The near-term guidance for Q4 and the full year 2025. It clearly reflects this tension we're talking about. Strong demand, but severe tariff costs.
The robust underlying demand prompted a slight revision to the full-year outlook. Management now expects total sales and revenues to increase modestly versus 2024.
And that's a slight improvement over their previous forecast.
It is. They believe they can overcome the challenges and still post year-over-year growth.
But this growth isn't uniform. They specifically noted that services revenues are expected to be about flat for the full year. Given the massive services push in their long-term strategy, why is that figure flat?
That's a crucial question. It's a bit of a head-scratcher. It suggests that while the P&E segment is driving services growth through those prime power applications we talked about,
Right.
the parts and repair revenues in the CI and RI segments, which are dealing with highly volatile pricing and cost structures, are probably offsetting those gains. It's an area that needs some structural improvement to support that big 2030 services target.
Let's nail down the single biggest headwind. The tariff expectation for the full year 2025. What's the final number?
The full-year net incremental tariff impact is now expected to be between $1.6 billion and $1.75 billion.
Let's just pause on that. $1.75 billion. That's revenue that is simply incinerated by external policy and trade friction.
It's a massive tax on the business, and this is why the AOPM is being pressed so hard.
And this leads us directly to the strategic debate around tariffs. Why hasn't management made more aggressive, permanent supply chain shifts to mitigate a multi-billion-dollar annual tax? I mean, they have the cash, the scale, the incentives.
This is where we need to challenge the premise a little bit. Management emphasized the enormous complexity and financial risk involved in large-scale supply chain shifts, moving manufacturing, certifying components, buying new tooling. It requires massive, multi-year, front-loaded capital investments.
So their rationale is essentially, why commit, say, $500 million to a permanent structural change if trade policy might just reverse in 2 years, forcing them to spend another $500 million to reverse it back?
Exactly. They require greater predictability and stability in the trade policy landscape before making those long-term irreversible investments. For now, they're prioritizing managing the impact through pricing and localized efficiencies where they can, rather than betting long-term capital on unpredictable political trade winds.
So they're just accepting the $1.75 billion tax as a temporary operational challenge while they wait for policy certainty.
That seems to be the strategy.
Let's look at the Q4 margin expectations. What does the final quarter of the year look like, factoring in this ongoing tariff cost?
Well, if you exclude the tariff impact, the AOPM for Q4 is expected to be higher versus the prior year, mainly due to continued volume strength. So the underlying demand signals are still favorable.
But including the tariffs.
Including the net incremental tariffs, which they project to be hefty, around $650 to $800 million in Q4. The overall full-year AOPM is expected to remain near the bottom of their long-term target range.
And those Q4 tariffs, where are they landing segment-wise?
Construction Industries is expected to absorb the majority of it, around 55% of the Q4 net incremental tariff impact.
Still the most exposed.
By far. Resource Industries accounts for about 20%, and Power and Energy for the remaining 25%.
Okay, now diving into the segment sales drivers for Q4, starting with CI.
CI anticipates a strong sales increase. It's driven largely by higher sales volume from a combination of changes in dealer inventories and sustained higher sales to end users.
And pricing.
Price realization in CI is expected to be about neutral year over year in Q4, which is an improvement over the unfavorable pricing we saw in Q3. However, management did note that even excluding tariffs, the margin benefit from higher volume will be partially offset by an unfavorable product mix.
And in Resource Industries, we have to factor in that Q3 pull-in we noted earlier.
Exactly. RI is projected to see stronger year-over-year sales, volume-driven, primarily due to dealer inventory changes. Price realization will still be unfavorable, but slightly less so than in Q3.
But the key is sales to end users.
Critically, we expect unfavorable sales to end users in Q4 compared to last year, specifically because of that early shipment timing that bolstered the Q3 numbers. It's a clear indicator of seasonality and timing shifts impacting the quarterly numbers.
And finally, E&T or P&E, the perennial outperformer. What's the Q4 forecast there?
Strong sales growth is anticipated to continue. It's fueled by that persistent strength in power generation and higher sales in oil and gas, specifically tied to solar turbines and related services.
And pricing remains favorable.
Price realization is expected to remain favorable, again, demonstrating their pricing power in these mission-critical sectors. However, the sequential sales growth rate for P&E between Q3 and Q4 is projected to be slightly lower than last year's historical pattern.
Why is that?
It just reflects the fact that Q3 was unusually robust and probably pulls some activity forward from Q4.
Okay, so that sets the stage for the short term. But the November Investor Day, that signaled a tectonic shift. This wasn't just a guidance refresh. It felt like a wholesale repositioning of the company.
Absolutely. The entire strategy is now built around solving these huge customer problems. Safety, labor shortages, productivity, reliable power. And this is addressed through 3 core strategic pillars.
And those pillars are?
First, reinforcing customer relationships and really expanding the services business. That recurring revenue is vital. Second, accelerating the deployment of advanced technology, autonomy, digital tools, connectivity. And third, transforming how the company works, which involves heavy investment in the workforce and modernizing manufacturing.
So the underlying message is they are pivoting from optimizing their cost base to aggressively capitalizing on these secular growth trends.
That's it. And this shift required a formal reorganization, which is already underway or planned for early 2026.
Let's talk about those changes. The first one is symbolic.
The immediate renaming of Energy and Transportation to Power and Energy, or P&E. It's both symbolic and strategic. It highlights that power generation, not just transportation, is now their primary focus and growth opportunity.
And the other moves?
Effective January 1st, 2026, they're moving the rail division from P&E into Resource Industries, RI. The goal there is to leverage synergies around machines that move high volumes of resources, like mining trucks and rail cars. They also consolidated their digital and technology divisions under one group president to streamline and accelerate development.
Let's discuss the single most powerful signal of confidence from this Investor Day. It's the change in investment philosophy. The previous strategy was all about optimization. This new plan demands massive capital deployment.
This is the crux of the transformation. They committed to a doubling of ME&T capital expenditures, a 2x increase when you compare the 2025 to 2030 period to the 2019 to 2024 period.
Doubling CapEx is an extraordinary commitment for a company of this scale. What does that signal to you?
It signals that the record backlog and the customer feedback are so compelling and persistent that management feels they must front-load capital spending to capture future profits. It suggests they believe the constraint on their growth right now is capacity, not demand.
And they specifically said this investment is front-loaded into 2025 and 2026.
Right, which means they're incurring risk and short-term pressure immediately to secure that long-term market share.
And that aggressive CapEx increase even impacted their current guidance, didn't it?
It did. They immediately updated the 2025 CapEx guidance from $2.5 billion to $2.8 billion, based solely on the immediate acceleration required for the solar turbines investment.
And on top of that, there's the tech spend.
Furthermore, investment in digital and technology is projected to increase 2.5x over the same comparative timeframes. They are betting heavily on technology, not just steel.
So where is this massive capacity expansion focus, particularly in the newly branded power and energy segment?
It's highly targeted. They're executing on the previously announced plan to double large engine capacity. But the most significant new announcement was increasing solar turbines capacity by 2.5 times the 2024 level.
And critically, this is not just for one turbine model, right? It covers the entire Titan family.
The whole family. This signals aggressive confidence in markets like LNG, pipeline compression, and large-scale power generation.
This brings us to the aggregate goal. What is the production target that all this capital is funneling towards?
The total capacity goal is an astounding 50 gigawatts of combined large engine and turbine capacity by 2030.
50 gigawatts. To put that into perspective for you, a single gigawatt can power hundreds of thousands of homes.
So 50 gigawatts represents immense, diversified, distributed power capacity they expect to deliver in less than 5 years. This level of investment is only justified by absolute certainty regarding massive, multi-decade secular growth trends.
Given this huge leap in confidence in capacity investment, they had to update their long-term financial targets out to 2030. How high did they raise the bar?
They raised the top-line growth target significantly. They're now targeting a sales and revenues compound annual growth rate, or CGR, of 5 to 7% from 2024 through 2030.
And that's a noticeable step up from the 4% CAGR they delivered between 2019 and 2024.
It is. They expect the market and their execution to generate anywhere from 25 to 75% faster growth annually.
And the profitability targets had to adjust, recognizing this higher revenue potential.
The adjusted operating profit margin range was updated to 15 to 25%, and this is now tied to a much higher projected revenue bracket, between $60 billion and $100 billion.
The previous range of 10 to 22% was based on sales between 42 and 72 billion. So this shift, it fundamentally rebases the company's expected scale and profitability ceiling.
That's a whole new paradigm.
Did they adjust the cash flow targets?
No, but they reaffirmed the high-end target. The MENT free cash flow target range was maintained at $5 to $10 billion, a range they already upgraded in 2024. They also formalized a critical revenue goal, hitting $30 billion in services revenues by 2030.
And that $30 billion in services underpins the long-term margin stability of the entire enterprise.
It has to. That's the key to de-risking the cyclicality.
All right, now we can move into the specifics. For that 5 to 7% CAGR target to actually materialize, each segment has to execute against these compelling market tailwinds. Let's start with power and energy, the segment getting the bulk of the CapEx.
P&E's ambition is just enormous. They're aiming to more than double power generation sales by 2030. This is built on massive, unavoidable global trends.
What kind of trends?
Management highlighted that global energy demand is expected to be 8 times the current U.S. annual household consumption over the next 10 years. And even with the energy transition, 50% of the energy mix in 2035 is still expected to come from oil and gas.
And LNG exports.
U.S. LNG exports are projected to double by the end of the decade.
That sets the macro environment, but the immediate explosive catalyst everyone is discussing is the data center opportunity.
The data center sector is an absolute goldmine for P&E. Data center power demand is expected to triple in the next 10 years. And Caterpillar is perfectly positioned because they participate in the full power and energy value chain.
From extraction all the way to generation.
From drilling and extraction to large-scale distributed power generation. They cited the gas 3520K genset as being key for the massive Joule data center project, providing critical primary and backup power solutions.
This focus on prime power engines running continuously 24/7, this is where the real margin leverage comes in, right? Far beyond the initial equipment sale.
That is the single most important insight from the Investor Day. They quantified this shift perfectly. A natural gas prime power engine genset running 247 offers a staggering 40 times more services opportunity over its life cycle compared to a standard diesel standby unit.
40 times.
40. When customers rely on your equipment for continuous operation, they simply cannot afford downtime. This mandates reliance on Caterpillar's high-margin services, maintenance, and parts agreements, driving long-term, predictable, recurring revenue well beyond the 2030 horizon.
And the expanded capacity at Solar Turbines, specifically the Titan family, that ties directly into that LNG export boom you mentioned earlier.
Precisely. The Titan 350 turbine, now getting that 2.5x capacity investment, is critical because it enables service to the downstream segment, specifically processing, refining, and exporting natural gas. Previously, they lacked a turbine of this specific large capacity that could fully address the scale required for modern LNG facilities.
So it fills a key gap in their portfolio.
A huge gap. Their comprehensive product portfolio, ranging from small reciprocating engines up to 10 megawatts and large turbines up to 39 megawatts, allows them to capture the growth across the entire spectrum of global power needs.
Okay, let's transition to resource industries, RI. This includes mining and will soon include rail. What's the fundamental strategic driver here?
The core driver is a pending CapEx supercycle in mining. Global mining CapEx is expected to grow by 50% by 2030. This is driven by inexorable demand for critical minerals required for the global energy transition. That demand is expected to increase nearly 40%.
You mentioned an astonishing fact about the existing fleet age.
Yes, the data is really compelling. The average age of a Caterpillar large mining truck is currently over 14 years. This is historically high.
And rebuilds are up.
Management has also observed a 5-fold increase in full machine rebuilds over the last 20 years, signaling that customers are aggressively extending the life of their old fleet. This pent-up demand, coupled with a need for new, more sustainable and autonomous vehicles, suggests a major replacement and expansion cycle is rapidly approaching.
How does technology drive RI's strategy, specifically around autonomy?
Autonomy is their primary technological pillar here. They're committed to tripling the number of autonomous trucks in operation by 2030. Furthermore, they are taking this proven mining autonomy expertise and scaling it down into smaller, high-volume quarry operations.
So not just the giant mines.
Exactly. There are over 20,000 quarry sites globally, and they're demonstrating success with lower-cost, retrofit-friendly solutions like those at Luckstone's Bull Run Quarry. This democratizes autonomy.
And the acquisition of RPM Global is a key piece of this puzzle for RI, isn't it?
It's fundamental to their precision mining strategy. RPM Global brings 50 years of expertise in sophisticated mine and financial planning, alongside maintenance execution software.
So by integrating this, Caterpillar moves beyond just providing the physical machine.
They move from just load and haul to offering integrated solutions across the entire customer value chain, from planning the optimal dig sequence to scheduling maintenance. They are aiming for true operational partnerships.
Resource Industries also needs to provide solutions for sustainability to meet customer ESG targets.
Absolutely. And they highlight products like the D11XE dozer, which achieves fuel consumption reductions of up to 25%. That translates to saving about 100 gallons of fuel per day. These sustainable cost-saving solutions are essential differentiators when you're facing a major fleet replacement cycle.
Okay, finally, Construction Industries, CI. Their growth target of 1.25 times the industry average is pretty ambitious. How do they justify that?
They see massive underlying market momentum that they expect to capture through commercial excellence. Global construction spend is projected to increase plus 25% between 2024 and 2034.
And within that, infrastructure is the big driver.
Civil infrastructure spend, roads, transport, utilities, is projected to increase by a massive 35%. And the U.S. rental industry alone is expected to grow 51% over the next decade. CI plans to leverage its dealer network and product breadth to capture this growth at a faster rate than their competition.
And their primary leverage point for that outperformance is digital services and connectivity.
Precisely. They have a huge competitive advantage built on connectivity. They currently rely on data from approximately 1.4 million connected and reporting assets worldwide.
And they use that data to push
Customer value agreements, or CVAs, and predictive maintenance. Tools like SOS analysis, which is fluid chemistry for early detection of wear, and Vision Link for condition monitoring, are crucial in helping customers minimize costly downtime and achieve a lower total cost of ownership.
They are also scaling worksite transformation technology to address labor shortages and safety concerns.
Yes, this includes scaling integrated tech solutions for difficult or dangerous environments, like remote operation cockpits and semi-autonomous features like grade control systems. And they're making significant investments to solidify their tech leadership, as you can see from their strategic partnerships.
With who?
With major tech players. NVIDIA for AI and digital twins in manufacturing, Microsoft for cloud infrastructure, and Snowflake for high-level data organization and analysis.
And those digital investments have concrete KPIs tied to them for the 2030 vision.
They absolutely do, and these targets reflect high confidence in their ability to monetize data and technology.
I'll run through them.
Okay. First, achieve at least 2 million connected and reporting assets. That's a 40% increase. Second, double condition monitoring PSEs. Enclose $1. So double the revenue from predictive maintenance.
What else?
Increase e-commerce by another 50% from last year's base. Achieve at least 500,000 machines with one or more advanced technologies embedded. And as we noted, triple the number of autonomous trucks in operation.
Before we conclude, let's frame this aggressive new investment plan against their history of financial discipline. The source material really highlights the success of their previous strategic model.
It does. And that performance since 2017 provides the critical confidence necessary for this massive pivot. Since 2019, Caterpillar generated a phenomenal $40 billion in free cash flow.
$40 billion.
That's an average higher than any other company in the S&P Industrials Index. Furthermore, their adjusted operating margins improved by 480 basis points over the 2010 to 2016 average.
That 480 basis point improvement is crucial. It's well above the midpoint of the original 300 to 600 basis point goal they set, which proves they have achieved structural, lasting improvement in efficiency and cost management.
And this financial strength is what enables this forward-looking strategy. Regarding capital allocation, management was highly reassuring. They reaffirmed their commitment to return substantially all free cash flow to shareholders over time.
So that suggests that while CapEx is front-loaded and high, any surplus cash generated will revert back to shareholders.
That's the commitment. And specifically regarding dividends, given their status as a dividend aristocrat,
Right.
the expectation is clear. They anticipate continuing to target high single-digit percentage dividend raises right through 2030, reinforcing the appeal for income-focused investors.
Let's address the core metric they use to evaluate the success of this 2x CapEx and 2.5x digital investment. Operating profit after capital charge, or OPATC.
OPATC is the ultimate measure of success for this management team. We should probably explain what it is for you.
Please do.
It's a measure that holds the business accountable for the capital they employ. It essentially takes operating profit and then subtracts a charge for the cost of the capital used to generate that profit.
So by committing to growing absolute OPACC, management is saying that every dollar spent on the solar turbines expansion or on digital initiatives must generate profit that significantly exceeds their internal hurdle rate for the cost of that capital.
Exactly. It ensures investments aren't just generating revenue, but generating actual value.
Finally, let's revisit that new operating profit margin range of 15 to 25%. If they're projecting a 5 to 7% sales CAGR, why isn't the expected margin pull-through even higher?
This brings us back to the trade-off inherent in this new strategy. The new range is inclusive of this aggressive investment cycle. Management noted that significant investments in capacity building new factories, increasing solar production by 2.5 times, will temporarily impact gross margins.
So investing in new capacity means they won't get the same leverage they achieved during the last cycle, where the focus was strictly on optimizing existing assets.
That's the trade-off. The 15 to 25% range demonstrates a commitment to driving absolute profitability while being realistic about the short-term margin friction required to fund this huge investment for long-term growth.
So the analysis seems pretty clear. Caterpillar is pivoting decisively from an optimization phase, which was defined by managing costs and maximizing leverage on existing capacity, to an aggressive investment phase.
Absolutely. The record backlog and the clear signals from customers, especially in data centers and mining CapEx, have validated the need for this 2x capital commitment.
And while tariffs and front-loaded CapEx are acknowledged costs, they're seen as necessary friction to transition the company to a structurally higher growth and scale trajectory.
The transition is monumental. That 5 to 7% sales CGR and the ambitious $30 billion services goal reflect a level of confidence in secular trends that we haven't seen from them in decades. And that confidence is justified by the visibility provided by that nearly $40 billion backlog.
And the most compelling long-term implication, I think, is found in that power and energy capacity expansion. Just think about the strategic significance of bringing 50 gigawatts of engine and turbine capacity online by 2030.
It's a game changer.
This expansion focused so heavily on those high run-hour prime power applications, it fundamentally transforms their long-term services profile. That shift from diesel standby units to natural gas prime power units generating 40 times the services opportunity means they're cementing decades of predictable, high-margin aftermarket revenue streams right now.
Securing profitability well into the 2040s and beyond.
Exactly. They're literally building the foundation for recurring, high-margin revenue through massive capital investment today. It's a strategic move that favors long-term structural value over short-term margin optimization.
That's a perfect summary.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.